The Wall Street Journal is citing a study on Monday that shows brokers at 4 major Wall Street firms have just 29% of their clients' managed assets in passive index funds. That's a surprise. That's well below the 45% passive rate for independent investment advisors. I want to just get some thoughts from you guys here and what you're thinking. Tom, this doesn't come as a big surprise to me. Brokers are naturally want to show they can pick some active fund managers who outperform at this point.
Yeah. Well, this is right up your alley. We talk about the SPIVA report that S&P puts out all the time, the fact that more than 90% of active managers underperform over 10 years. Bob, when we're talking about fees, performance has to be in that same dialogue. And as we continue on, those advisors that tend to be in the wirehouse area that don't have enough allocated towards passive and have higher fees, and most importantly, if they're actually making 12B1 fees or they're making other commissions that aren't naturally disclosed in a more public way, there's a lot more room for consolidation.
Matt Hougan, it's no surprise to me that obviously these firms here are embracing active management a little bit more. Should Wall Street firms be embracing passive investment more seriously than they have been?
Oh, absolutely, and it's going to happen, Bob. These are just the late adopters. The RIAs are the early adopters. The wirehouses are the late adopters. You're going to see that number tick up from 29% to well over 50%, I think, in the next few years. A lot of people think, indexes are now larger than active management. The game is over. I actually still think it's just starting. I think you're going to see index assets continue to grow at both the RIAs and the wires, and the wires are going to have to catch up quickly or they're going to be left behind.
And what's the implications for that, Richie? I mean, lower cost products they're going to have to keep introducing at this point?
Well, I think you'll continue, fee compression across the board will still occur, particularly in active. But I think there's always a room for active management and asset allocation. I don't think it'll totally go away. And I think a lot of those assets will be ported over into semi-active transparent ETFs that will be introduced sometime next year. So, my belief is that the pie is big enough for every type of instrument to be utilized. It really comes down to price transparency and best advice for an end client. So if advisor is still using an active strategy, it's probably the best thing for his client, but single factor beta ETFs, they are, the cost is pretty inexpensive, and I think that they'll be adopted further going forward.
And this move towards non-transparent ETFs, out of active mutual funds into non-transparent ETFs, that's such a big thing right now. We haven't seen it really happening in any extent. A lot of people seem to feel that this is going to be the savior of the active management industry, but I don't understand this. If you're mediocre at an active mutual fund, why are you going to be better at an actively managed ETF, even if the fee is slightly lower?
Look, the winners will win because they deliver the best thing for their client and actually make money in returns. But really it's about delivering the model. The ETF wrapper is going to become the investor choice utilization model.